Inflation has surprised on the upside, just as an energy shock tightens its grip. Yet AI-driven equities are still hovering near highs, and volatility remains contained. This mix of strong earnings, higher yields, and fragile geopolitics is forcing allocators to reassess how risk is priced across every major asset class. Welcome to vTalkInsight, Allocators Lens Daily for May 13th, 2026. In equities, the story is still about powerful earnings and AI-driven growth holding the line against a much noisier macro backdrop. Major benchmarks in the United States sit close to record levels, even as inflation, oil, and rates all push higher. Corporate results have been exceptional. First quarter earnings for the large-cap United States index have grown more than a quarter year-on-year, roughly double earlier expectations. Technology, and especially semiconductors, are a big part of that, but the surprise is also broad-based, with most sectors beating forecasts and even smaller and mid-sized companies seeing upgrades after a long pause. The AI investment wave is central here. Cloud and hyperscale platforms are reporting a sharp acceleration in backlogs, and chipmakers are enjoying strong pricing power thanks to supply bottlenecks and industry consolidation. Selective names illustrate this earnings leverage, from industrial technology companies posting double-digit price jumps after raising guidance, to smaller semiconductor firms surging on strong outlooks. But the quality of the rally matters. A small group of mega-cap technology and chip stocks now dominate index weights, with the top cohort making up a very large share of both United States and global equity benchmarks. Semiconductor indices are up dramatically year to date. Options markets show intense call buying in the biggest tech names, and traditional valuation measures sit well above long-term averages, helped by optimism around AI infrastructure. So far, higher bond yields have not done much damage to the largest cash-rich companies, and broad volatility remains below the levels usually associated with real stress. However, momentum indicators are stretched, leadership is narrow, and gains in the main index mask internal weakness, with many constituents far from their highs, even as the headline index pushes up. From here, the equity question is whether earnings and AI capex can keep outrunning the drag from higher rates, expensive energy, and geopolitical risk. Watch for any sign that the oil shock or renewed tightening rhetoric starts to feed into earnings guidance or into the currently calm volatility regime. That is where a resilient equity tape could quickly become more fragile, and it sets the stage for how we think about rates next. In rates, the latest inflation numbers have pushed markets further toward a higher for longer stance. Headline consumer prices are running close to 4% year-on-year, with core around 2.8, both above expectations and well above the Federal Reserve's target. United States Treasury yields have moved up across the curve in response. The 10-year note is testing cycle highs in the mid-4% area. The 2-year has also pushed higher, and the 30-year is holding above 5%, a level that keeps term premium and policy risk firmly in focus. The most dramatic action, though, is in the United Kingdom, where political turmoil and fiscal concerns have driven gilt yields sharply higher. 30-year gilts are now near 6%, their highest level since the late 1990s, and the rise has far outpaced the move in United States Treasuries, underscoring how quickly a political risk premium can build in sovereign markets. Central banks face an awkward mix of sticky inflation, energy-driven second-round effects, and already elevated yields. The Federal Reserve is widely seen staying on hold, with cuts pushed aside and some probability now assigned to renewed hikes, while other authorities are constrained from easing by the inflation impulse coming from the Middle East energy shock. For multi-asset portfolios, this reinforces two challenges highlighted in recent months. Bonds are offering higher running yields, but they hedge equities less effectively when inflation is above the 2.5% to 3% zone, and sovereign markets with fiscal or political questions, like the United Kingdom, can move violently, feeding back into global risk sentiment and into credit. Credit sits at the crossroads of this higher yield world and the equity optimism. On the public side, issuance has been very strong, particularly in United States investment grade, where corporate supply has even exceeded net treasury issuance for the first time in years. AI-related capital expenditure is a major driver, with large technology and digital infrastructure companies tapping multiple currencies to finance data centers, power projects, and chip capacity. United States corporates now account for a substantial slice of the European credit universe, reflecting this cross-border financing wave. Despite that supply, inflows into liquid credit remain healthy and spreads are tight, helped by strong earnings and generally solid balance sheets. At the same time, there are early signs of asset quality deterioration and some stress in less liquid areas. Non-traded vehicles have faced redemption pressure. High-profile managers have had to commit capital to support flagship funds, and questions are building around how much investors are being paid for illiquidity. Current positioning indicates a preference for high-quality, shorter-duration liquid exposures over stretched private credit segments, and some allocators express a tilt toward taking risk in equity rather than in subordinated or opaque credit. The key watchpoints are whether higher policy and gilt-driven yields start to widen spreads from very tight levels, how concentrated AI and infrastructure-related themes become within credit portfolios, and whether episodic liquidity events in private markets remain contained or evolve into a broader cycle of repricing. In foreign exchange, the energy shock and geopolitics are keeping a floor under the dollar even as the rate debate evolves. The United States benefits as a net energy exporter, while higher import bills weigh more heavily on parts of Europe and Asia, reinforcing the dollar's resilience during this phase of the Middle East conflict. Sterling has weakened notably, reflecting both global dollar strength and domestic political uncertainty, as gilt volatility spills over into the currency. In contrast, Japan has drawn a clearer line in the sand on yen weakness, with authorities intervening and signaling that further action, or even a policy rate move, is on the table if the currency slides back toward recent extremes. Alongside these moves, there are quieter but important shifts in the role of the Chinese yuan. Use of the currency in cross-border payments and central bank swap lines has risen, and Chinese authorities appear comfortable with a measured appreciation path, which could support other Asian currencies tied to China's cycle. None of this replaces the dollar's dominance, but it does suggest a slow broadening of the reserve and invoicing landscape, adding another layer to cross-asset risk management. Commodities are where many of the macro forces we have discussed converge. Disruptions around the Strait of Hormuz have taken a meaningful chunk of global oil supply offline, with weekly losses measured in the tens of millions of barrels, and some analysts not expecting a full return to pre-conflict capacity for years, even if shipping lanes reopen. Crude benchmarks are trading firmly above the $100 area, refined products are elevated, and gas producers are flagging sizable earnings hits from the disruption. Freight costs have jumped as well, with container and air cargo rates rising on higher fuel and insurance, feeding quickly into broader logistics inflation. Beyond energy, copper prices have surged to near record levels, reinforcing the signal of robust demand and constrained supply in parts of the industrial complex. Gold has faced headwinds from higher real yields, but ongoing central bank buying provides a counterweight, and many allocators are re-examining hard assets as diversifiers in a world where elevated inflation weakens the traditional stock bond offset. How the oil shock, copper strength, and inflation data evolve from here will be central to the next phase of both policy and cross-asset positioning. Putting it all together, equities are still priced for strong growth and extended AI cycle, but the combination of sticky inflation, higher yields, and an energy shock is narrowing the margin for error. Rates markets have quickly repriced to reflect hotter consumer prices and political risk, especially in gilts, while credit juggles tight public spreads, heavy AI-related issuance, and emerging strains in private vehicles. The dollar remains underpinned by energy dynamics and policy divergence, even as the yen and yuan stories hint at a more multipolar currency backdrop, and commodities sit at the heart of the inflation and stagflation debate, with oil and copper carrying outsized signaling power. For allocators, the key watch points are the next rounds of inflation data, any change in central bank language on renewed tightening, developments in the Middle East and United Kingdom politics, and signs that equity or credit leadership is starting to broaden or crack. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.